At Insightful Value, we uncover companies that fly under the radar but deserve a second look. And today's spotlight is on Selective Insurance, a solid insurer whose stock is surprisingly undervalued right now. This video is for informational and educational purposes only, not financial advice. Selective Insurance Group is a U.S.-based property and casualty insurance company that operates in 31 states. They provide commercial lines, personal lines, and flood insurance, and are known for their strong regional presence and local agent-driven distribution model. So, what's going on with the stock? Over the past year, SIGI shares have lagged behind broader financials and the insurance sector. But fundamentally, the company looks strong. In the most recent quarterly report, Selective posted solid premium growth, with net premiums written up by nearly 11% year over year. Underwriting profitability remains healthy with a combined ratio in the mid-90s, and their return on equity is hovering around 13%. That's very respectable for an insurer of this size. Selective Insurance has been consistently profitable, maintaining a conservative investment portfolio and a relatively low-risk business model. Their financial position is backed by strong credit ratings from agencies like PEST. One of the highlights for long-term investors is the company's steady dividend growth. SIGI has increased its dividend annually for 13 consecutive years, with the current yield around 1.7%. The payout ratio remains modest, leaving room for future growth without compromising capital. The stock's decline appears driven more by market sentiment and short-term worries than fundamental weakness. Rising claims in some regions and higher reinsurance costs are pressuring margins industry-wide, and Selective is not immune. However, management is actively adjusting pricing to maintain underwriting discipline. So, why might this be an opportunity? The stock is trading below its historical valuation multiples on both earnings and book value. At these levels, you're getting a well-run insurance business with consistent earnings, growing premiums, and a disciplined capital strategy at a discount. On the other hand, investors should note that insurance is a cyclical and competitive industry. Catastrophic weather events, rising litigation costs, and regulatory shifts can all impact profitability. And while Selective is solid, it's not a high-growth story. It's a steady compounder, not a rocket ship. Still, in uncertain markets, businesses like this, that quietly deliver year after year, often make the best long-term plays. At Insightful Value, we focus on exactly this type of company. We break down overlooked businesses with strong fundamentals and explain them in plain English. Whether you're new to investing or looking to sharpen your edge, our approach helps you make better decisions with confidence. You'll find more deep dives like this one at insightfulvalue.com, where we keep the focus on value, not hype. If you like this review, hit subscribe and check out our site for more in-depth analysis of companies worth watching. That's insightfulvalue.com.